knowledge and the rhythm. This is what I'm using to come up with a style, so I'll interact all together better with the crowd. Nervous for a second and the record starts spinning, and I fall into the state of mind of what I've just created. Pumping like the doctor, D into the RE, suckers ready to leap up on the tip when we made it. Created so I'll never be regarded as a regular, more than just a little bit better than my competitor. You should never underestimate the fashion. I hope for the stage, whether I'm cooling or thrashing. Clocking the concoction created by me. When read, you read, E equals a D-O to the C. Knowledge and the talent that my mother had born to her equals an artist I won't be born. What is that, Dre?
It's the formula. Hey, it's Soleil, and this is episode 428 of the Orange Pill Investor. Took the day off from the regular live stream to interview Mechanic yesterday. That was a lot of fun. I got to give my man Tim Kotzman a little bit of extra respect and props for doing that every day, multiple times a day sometimes. It's not backbreaking work, but it is mentally exhausting. Having conversations with people is fun, but when you have to like multitask, trying to like pay attention to the person, listen to everything that they're saying, but also be like multitasking in your brain with, okay, do I ask a follow-up question about something that they said? Do I go to my list of questions that I have? Like, plus the information that he was presenting is like super complex. Like, it's kind of funny. It's almost embarrassing the level of ignorance that I basically exposed myself to, going down this rabbit hole of op return and Bitcoin knots and Bitcoin core, filters and spam. It was like, okay, I've been a Bitcoiner like for 2 full cycles, hundreds, maybe thousands of hours of just podcasts, listening to Saylor and Jeff Booth and Saifedean and just all of these people. And it was a little bit humbling to realize that my knowledge level was extremely lacking on something that's, not necessarily of the end of the world. I think Bitcoin survives or whatever, but it's definitely a threat. The fiat system is guaranteed to try to attack Bitcoin, right? If they can't destroy it, which at this point they can't, then they have to try to co-opt it. Jeff Booth thinks that they'll try to co-opt it on layer 2, but, infiltrating the devs, maybe offering financial incentives or kind of, or maybe even just kind of counting on Bitcoiners getting lazy and just kind of assuming that Bitcoin will survive without having to actually participate in defending the network. Complacence, that's the word I'm looking for. Counting on Bitcoiners becoming complacent and just assuming that we've already won the war. There's a lot of fight left in the fiat system, I think. So I know some people are even thinking, okay, before your cycles in Bitcoin are over, we're going to get adoption. We're going to have less and less volatile spikes. And I don't know if I can totally get on board with that, because it just seems like there's going to be a lot of thrashing about as the fiat system has to just print and print and print. So I'm not sure if we're going to get less volatility or more. We might end up with more. But anyway, that was a lot of fun. Big thanks to Mechanic for doing it. And he was we had to postpone it until he got back from Prague so they could make some time. So just grateful that he was able to do that. And people can decide for themselves uh, if they're going to be a new node runner or if they're were formerly running core. Do they want to switch to knots? I got my server up and running last week, and I am running knots myself. And the last little thing that I need to do, and I hope I don't have to buy a new router, but I got to look and see if I can get my Verizon router to, was it forward port 833, something like that. I know if I had my own router, I would be able to do it, but since I'm like renting this one from Verizon, comes with the standard, whatever high speed router that comes with their service. I'm not sure if I'm going to be able to tinker with it. So we'll see. And the only difference that makes is I think that makes it visible or not, or excuse me, I think that's not necessarily that it makes it visible, but I don't think it can be a listening node if that port is blocked. But then I think a consequence of that also is that my knots server kind of isn't being counted. Like if you go out there and look, like, oh, we've got all these new, knots servers coming up. I think knots adoption went up from like 2% to 13% or something recently. So I think my server is not standing up and being counted. So anyway, that was a lot of fun. Justin is gonna try to um, see if he can get the noise out of that recording in post production. I couldn't hear it. When I just stream myself, there's no issues. But for some reason, it seems like when I host, because the same problem happened to me on Wednesday when I hosted the True North call. They were like, "Hey, you got to mute yourself because there's background noise." And for the life of me, I couldn't figure out what it was. But I think something happens when I host on Restream. The noise cancellation is turned on in Restream, and noise cancellation is turned on with my beacon. But I think they either like cancel each other out or something. So I'm gonna have to troubleshoot that. But um, Restream's got some tools, and it did get that sound out. So we'll re-upload it. But it was with must be like an affiliate link or something called Descript, and they added a watermark, which is kind of annoying. They want you to use a paid service to take the watermark off. So that was the native tools that I had available to me to try to clean that up post production. But Justin's going to use some of his stuff that he has, J64, and see if he can get it cleaned up. So there might be a better sounding re-upload coming soon. And before I actually host another live stream, I will have to battle test it and make sure I get the bugs worked out on that one. So let's see. What's up, Dion? So he says, how do you choose what stocks to run the wheel on? Just one stock you're bullish on, two volatile, three high premiums. Yeah, great question. So 4 years ago when I started, I guess it's 5 now, May of 2020 when I started selling options, the only thing I cared about, and I'm not going to be able to show the what. Oh, okay, good. This is disabled, so I can show this. All right. So what I used to do was go to Market Chameleon, and I would just sort by like the 30-day implied vol, and I would waste a metric shitload of time just checking every single one of these tickers. And the only thing I cared about was the options premium. Was there going to be your number 3 there, high premiums. Um, I got myself into a little bit of trouble because, being inexperienced, like, Hertz was on here, the rent-a-car place, and so I'm like, "Oh, cool, I can get a bunch of premiums in Hertz," and it was a super cheap stock too, so it was something really cheap for me to kinda, like, practice on and do. But then I I was already, making some trades, and then I come to find out they were, like, in bankruptcy talks, I think, and I was like, "Oh, shit, okay, maybe I need to do a little bit of market research here." So I spent, like, wasted a lot of time just kind of checking this every day, looking for stuff, and, like, some of these biopharmaceutical stuff, you gotta be really careful with them because they might have high implied vol because they're about to find out whether they get FDA approval or not, and if they get it, the stock could go way up, and if they don't, the stock could go way down, and neither one of those scenarios are really optimal for a covered call seller. So, that was a long way of saying that when I first started this, I was completely agnostic to the ticker. I didn't do any fundamentals whatsoever beyond, like, were they gonna go bankrupt? I have since transitioned, over time, kind of learning about a couple of stocks, but then also, once I got my laser eyes, I figured, why not just be Bitcoin derivative only? So at this point, I won't even deal with any of these stocks because they don't have Bitcoin on their balance sheets. So that would go into, um, number 1, the stock that I'm bullish on, I guess. Anything Bitcoin derivative is not necessarily guaranteed to win, but they have a hell of a lot better chance than any of this other bullshit that's still living in the fiat world. They got both feet in the fiat system still. And then number 2, you said volatile. Yeah, so absolutely. It has to be volatile to a certain extent. Um, because I could go here to this INMB, even though it has a 400 IV, you would think, "Oh my god, it's gotta have amazing premiums." Sometimes that's not necessarily the case. So you can go to some of these tickers, and you don't necessarily see a one-to-one direct correlation between a huge IV and actual premiums that you can wring out of that stock. So, this was kind of like a guide that I was using, but it wasted a lot of my time. Now, as far as volatility is concerned, the volatility itself is meaningless if the premiums are not high. So that's really the only number you really need. The premium is the truth. Um, the Greeks, the implied vol, the Vega is the sensitivity to the implied vol. If all of those things look perfect, but if I went here and I was like, okay, do I want to sell a cash secured put up $39,000 worth of capital up, right? For a week, and I could only get like 20 cents here, but it said that implied vol was like 150. Like, okay, I'm not gonna invest in it just because implied vol is high if the premiums are shit. So the options price itself is the most meaningful statistic, in my opinion. Now, with this, right now, the is it? Oh, so next week is the 4th, so we're getting one less day. Okay. But that being said, even though strategy is a heck of a lot better premium than 99% of the stocks out there, it is low. Um, actually, I got to make sure. Yep, I'm in privacy mode. Okay. IV Rank, this is Tasty Trades platform. This is like going back a year, basically. And so this is like the sixth lowest that the IV has been in the last year. Sixth lowest day. Recording IV rank every single day for the last year, and this is like the sixth lowest. Let's see if I can get this to refresh. Yeah. Implied vol is a mean reverting statistic, and I still do like Market Chameleon for this chart, this implied vol chart. And you can see that before November, this was kind of like the baseline, 70, 80. And then we're like, bam, there was November. And then it reverted to the mean, 100, 90, bottomed out at 70, popped back up again. But you can just kind of see it. But now it's just been trending down and down and down. And I think it's because of the leverage ratio that Jeff shows every Wednesday. Like they're just under levered. And what it seems like is they are relying more on the preferreds, which is the most accretive way for them to stack Bitcoin. You can see along their journey, if you follow what they've done, they just keep trying things. They did convertible bond deals. They were doing common share ATM, and all of those things had were accretive for Bitcoin, but they all have their own trade-offs. So there's like Thomas Sowell said, there are no solutions, only trade-offs. And it seems like they're kind of learning like the trade-off of dealing with the bond traders who are not necessarily on our side, right? They want to make money. So they don't mind taking this long position and immediately hedging half of it. And then when Strategy's price goes up, they hedge it some more, and they just could be putting a little bit of a damper on Strategy's price action. Now, that's not necessarily all bad, because when Strategy bottomed out at 250 after November, down here, maybe the bond traders had shorted more up here and stopped us from going higher, but maybe they were also buying here because their delta had changed. I think somebody in the comment section said that they're also trading around gamma as well. Whatever the case may be, there could be, I don't necessarily want to say unintended consequences, because I think everybody in the space knows how the bond traders behave. I didn't until until we started covering it, but that era might be over. I mean, it's probably a lot of work. They have to go out to the market. They have to deal with these guys. They have to deal with the second and third order effects of what that's going to do to the market. And with the development of Strike, Strife, and Stride, they just might not need them anymore. So unfortunately, we may not get this barrage of like bond deal, bond deal, bond deal, bond deal, and we get, I don't know, $5 to $10 billion of Bitcoin bought in a month and a half or something, and just get all of this overwhelming excitement. It might just be the preferreds grinding away and gradually turning up the heat on the leverage, which should turn the heat up on the willingness of the call buyers to YOLO into these options. Right now, I think the leverage ratio is low, and the lower the leverage ratio is, I think the more of a discount call buyers are giving to, like, do I think this could just quickly run to 450, 500? And I think the call buyers and the call sellers are both saying no. We're not really scared of that right now because strategy is under leveraged. They can take on a ton more debt. So the leverage might just be kind of like grinding up. We might not be getting the big bond deals anymore with these smash buys, which could mean that we'll be seeing low IV for longer unless Bitcoin itself makes a move. But then I think once the preferreds really start to mature and they can just hammer, right? I think they were buying like, you know, when they did the initial Stride purchase, they had like $700 or $800 worth of Stride money. So that week they had like a big $10,000 Bitcoin purchase. But otherwise, it's like, oh, okay, we'll get 1,000, we'll get 2,000, we'll get 4,000. It was just kind of like ho hum, another dot on the chart for dot day. But they weren't all big dots. But still, if they carried out, if they averaged 3,000 Bitcoin a week for the rest of the year, that puts them at like, are they at 590 plus another 78 gets them to like 670,000 Bitcoin by the end of the year, which is insane compared to how many they had last year. But that could all depend on how quickly the markets ramp up for STRF, STRK, and STRD. But I think the key to the formula is the STRD. And at first I was confused when it came out because I was like, why? When they came out with, the flagship product, the Strife, that's at the top of the capital stack. I'm like, well, why would they build something that's worse? Like, who wants the worst one? But that's kind of the point, is you don't want to build the worst one first and then rug pull it with something better. You come out with the expensive Rolls-Royce products first, and then you build out the cheaper model that everybody can afford. And the whole point of Stride for people who are willing to take on a little bit more risk, because the STRD, they technically could not pay the dividend. I think there's as close to 0% chance of that happening. Some kind of rounding, basically a rounding error chance of them not paying the dividend on STRD. Because the second they do that, they just lose all credibility. And that doesn't make any sense. But what I'm really hoping is that they really hammer Strife and Strike now, and they keep that STRD as like, in case of emergency, break glass. So if Bitcoin starts to go into another bear market, if the shorts, start smelling blood and they start shorting strategy down to like close to 1x MNAV, STRD is that one preferred that they can continue to use even in like the worst conditions, because since it's not like the AAA rating type, they don't even have I don't think any of them rated at this point, but I'm assuming that the Strife ones will be like AAA rated. And STRD, because it's a bit more risky, will either not get rated or it'll be rated much lower. I guess it's possible even STRD could get a high rating, but the point is they don't really need it. And if they had to, they could even risk, getting a poor rating on STRD in order to defend against the shorts in a Bitcoin bear market. They can. Uh, I watched Dan on Bitcoin Not Crypto's channel the other day, and he did a great job of describing uh, how it works. You have to be a little bit more careful with the being over leveraged with a product like STRF because you don't want to risk its high credit worthiness. But an STRD you can kind of use and abuse at higher leverage ratios. You can take on much more obligations because you have that get out of jail free card of if they just don't want to pay the dividend at some point, they just won't. Um, like I said, I think that's highly unlikely, but you have to construct that product in a way that distinguishes itself from the more creditworthy products. But the beauty of it, of the Stride, and it's the one thing that no other Bitcoin treasury company has. And I think that it's only a matter of time before you'll see like the Meta Planet will roll these out. They seem to be implementing Sailor's playbook in the most, you know, perfect way since Strategy implemented it. Uh, so I think they're going to be they'll certainly end up in that direction as well. But yeah, some of the other companies are coming out. You know, they're doing deals where their Bitcoin is encumbered. There's all kinds of different things with some of these other horses that might be faster horses potentially. But for right now, it seems like the preferred series of stock offerings is going to be like the unlock for being able to stack Bitcoin in a bull market, in a bear market, defend themselves against the shorts that just want to short the damn stock into oblivion and compress the MNAV down to 1 or even below 1. So Bitcoin treasury companies, especially the leveraged Bitcoin companies, are basically all on notice right now. You have to have an STRD type product, I think, to defend yourself. If you just want to be Tesla and buy Bitcoin and have it on the balance sheet, they may not be the best example because they're not exactly diamond hands holders. They've sold a couple of times, I believe. But if you just want to buy Bitcoin and hold it, that's completely fine. You don't need an STRD to defend yourself because someone like a Tesla they're just innovating, right? They're selling cars. They're going to have a money printer with their cyber cabs. Their Optimus will be a money printer. So they don't necessarily need to even bother with dealing with financial products. They're just doing what they do best. And I think every company that just wants to hold Bitcoin can absolutely do that. You don't have to do the bond deals and take on debt for this. If you are already providing value, then that's probably not necessary. But it's these zombie companies that are not already dominating that are going to rejuvenate themselves with the leverage plays. So they keep unlocking new ways to be more and more accretive, right? People complained about the common ATM, and we haven't seen common ATM for like a month. Could have clearly, bought more Bitcoin if they were hammering the common ATM, but they all have their own trade-offs, right? There's the sentiment that the common ATM has as well, right? It's demoralizing for some of the long-term investors, seeing Sailor sell sell the shares at a high price while we're hodling, gives some people heartburn. It is accretive. Like all of those arguments that we've been making the whole time are still true. It's just, okay, well, wait a minute. Why stop there? Why not innovate? Okay, well, these preferred stocks are even more accretive than the bond deals, even more accretive than the common ATM. And they're all just levers that we can that we I said we that they can pull, right? I mean, if strategy launches itself to $1,000 a share, will they probably hit the common ATM again? I would assume so. They got to hit it at least a little bit. If the MNAV expanded to like 3 or 4 or 5 or something, that would be extremely accretive to hammer the common ATM to buy Bitcoin with. So this may be kind of like a slow grind for I might be one of those gradually then suddenly types of things, right? We might see the leverage ratio just kind of grinding up as the preferreds mature, but then at some point, like Bitcoin's going to make a move, strategy's going to make a move, and I'm assuming that this IV rank will the pendulum swing will go in the other direction, and we'll get another one of these bad boys. If that doesn't happen, like the premiums on strategy are still legit, but in the current environment, I am still trying to stack as many long calls as possible at these low IV prices. Even though strategies like 25% off all-time highs, you can either say that that's buying the dip, or you can say it's up from 250. Whichever story you want to tell yourself, you can always create a narrative whether you think the stock is cheap or expensive. I think it's going to be higher in the future. It doesn't mean it can't be 250 next week, but in a year or 5 years, I think the price is going up. I cue the not financial advice video. Maybe I'll start playing Tim's not financial advice clip on this channel too. I'm still waiting for wisdom too, Howard. Let's see, Dion, is there a site that shows premium rank like Market Chameleon shows the IV rank for a stock? Yeah. Most other sites don't use IV rank, they use IV percentile, and that's all reasonable as well. There's some kind of yeah, I'm sure you can find someone using IV percentile somewhere. Let me see if they have something here. They really like the IV 30% rank. This one might be it. IV 30, but for 52 weeks. I don't know. I don't really pay that much attention to it anymore. Like I said, the only thing that really matters is the premiums. The premiums divided by the amount of collateral that you have to put up to make the trade. All right, I'm kind of stoked with the price increase. I'm just going to jump right over to the covered call challenge against the ETFs. So this one is up big time. I was kind of blessed, I guess, with perfect timing. I sold 100 shares, and I bought 2 leaps for poor man's covered calls 10 days ago. And with the price being up, what, $20 a share since then, I got basically twice the amount of price action right? I bought these for 193 and they're up to 212, so that's like 1900 per leaps. And my covered calls are still basically break even. So I haven't made or lost anything on these positions. Whereas if I only had 100 shares here, I'd probably be up half this amount. The delta on these each is 90. So I'm getting basically 90 cents on a dollar for every dollar that strategy goes up, I'm getting 90. So since I have 2 leaps for approximately the price of 100 shares, I'm getting $1.80 every time strategy goes up a buck. Yeah. So I really took the lead against them. And that's one of the benefits that can also go against you if the price is going down, right? If the price went down to 250, this position would have absolutely cratered. And the covered call ETFs would probably be winning because I took this leverage position. But these types of things are the things that a retail investor is allowed to do that the covered call ETFs really can't do. They cannot just do this poor man's covered calls. Some people think that that's what they're doing. I've heard other people saying that MSTY is selling a poor man's covered call, and they're calling this a synthetic stock position. But this is not a synthetic stock position, because if the price goes down, there's a Greek called gamma that is going to make this delta value decrease as the price goes down. Gamma makes delta go up as the price of the stock goes up. And so a true synthetic the delta wouldn't change. So I'm exposing myself to more risk than the covered call ETFs are. So the way that the covered call ETFs would work, and it really doesn't matter how far out we go, but I think they go out like a month. For them, they would need to not only buy the call like I bought, and to make mine relatively safe, I had to buy mine very deep in the money. But let's just say that they wanted to create a synthetic at 375. They not only have to buy the call, but they have to sell the put also. And you can see that the delta on the put that they sold is 34. The delta on the call that they bought is 65. That basically adds up to 100. 100 delta is equivalent of 100 shares. So this creates a synthetic position. So they don't have to just buy the call, they also have to sell the put. That forms a true synthetic position. And if the price of strategy moves, it doesn't really matter, because if you buy this call and sell this put, the delta on the call is going to change, but the delta on the put will also change, and it basically stays at 100. 78 and 21 is 99. Close enough for government work. So the benefit of this is that I got leveraged price appreciation since the price is up, 10, 20 bucks since I bought this. The downside would be if we didn't go from 375 to 395, instead if we went to 355, then I would have lost a bunch more money than if I was just holding shares. And since I have 2 of these positions, I would be losing double the double. So it's great when the number goes up, but not necessarily. It's definitely a double-edged sword. Again, I sold these so far out in the future, I probably won't even end up taking these off until August 7th, which is earnings. I won't carry these over through earnings. It's possible I could end up rolling these out, before then, but that would be a bummer because the only reason that I would roll these out early would be if Strategy's price is collapsing. So hopefully we'll just cruise along or go up, onwards and upwards. Yeah, so really no tweaks for me to make at this point. Maybe I would even let these go close to expiration. Otherwise, I might have to roll these out at some point. In the challenge account, I am kind of holding myself to maintaining a positive net theta, meaning there's more money draining into this account than out of it. Whereas on my other accounts, I'm being much more risky. I'm actually losing money every day when strategy doesn't go up, which is not in keeping with the true option seller spirit. But that's just I guess an example of how bullish I am at this point. Dean says, is picking up 1% premium per week a conservative target? So if you talk to any of the TradFi people, going for 1% a week is absolutely insanely risky. There are some very good TradFi covered call sellers that I respect that are like a quarter to 0.5% a week is a good goal, but they're not like laser focused and on Bitcoin derivatives. So they're not really used to the high vol that you can get really at any time. And so, yeah, 1% a week is kind of like my baseline that I try to shoot for, right? So, like on a weekly, what, like yeah, see, it's tough to get 1% right now, though, because the IV is so low. You'd be at like the 405, 400, 402, 4250. And that's not like a lot of upside. You'd be capping your upside at 402. So it is tough to squeeze that out in this environment. If I didn't have to live off the premium, I probably wouldn't have any covered calls on right now. I'd just be waiting for that next leg up to, I don't know, 6, 750, 1,000, and then I would just really go hardcore on the covered calls again. But let's see, 40. Okay, so they finally have the August 8th dates out. These are the ones I was looking for before, but they weren't available. When I go 45 days to expiration, I assume that I'm going to try to roll them every 2 weeks and that I will keep half of the premium. So in order to try to shoot for 1% a week, that means I would need to divide the premium that I collect at 45 days by 4, right? Because I'm going to collect half every 2 weeks. So per week would be half and half again. For the most, I wonder why the bid-ask spread sucks so bad right now. I'm not sure what's up with the liquidity. The bid-ask spread on the 445 is terrible. You'll get a fill because there's a ton of activity, but sometimes the market likes whole numbers. But anyway, to get to get 1% a week optimally, I'd have to multiply this basically by 4 and sell the 1600 strike. Excuse me, the strike that would get me $1,600 worth of premium, which I'm trying to divide is probably around the 430. And this just seems a little bit aggressive. So I think you have to adjust your expectations to the market. With extremely low IV right now, I don't think it's reasonable to shoot for 1% per week. I generally like to stick between the expected move, which is this red line here, and the 1 standard deviation line. Like anywhere in here is kind of in the ballpark. And so if I hit the 450, let's see, the mid price would be what, like 11. Um, let's call it 12 for easier numbers. So 12 divided by 4 would be 3. That'd be 300 a week. So that would only be like 0.75% a week, best case scenario, and would give upside up to 450. So like 10, 12% call away value. But again, with Ivy this low, it's like it's not really an optimal time to be an option seller. It's kind of like buying season. So just be careful and match your expectations, right? Especially if you only have like 100 shares. If you have 1,000 shares and you're risking some of your stack for the first time, um, that's a little bit easier to stomach than if you only have 100 shares. You sell the 450, the price goes to 550, and you missed out on like $10,000 of upside to collect $1,000 of premium. That can cause a lot of heartburn. So just make sure that you're mentally prepared, or, not only weighing the risk of the price stock going down, but weighing the risk of how you're going to feel if the price goes up and you miss out on some gains. I think that's a lot less of a risk. Like in September, it would have sucked to sell the 300 strikes before it went to 500. But when the price was at 500, just selling covered calls after the price has already gone up 4x is a lot easier to stomach. Like if it had, if the price was 125 and it went to 500 and you've already captured a 4x, and then you sold the 500 strikes and it went to 1,000, like, okay, you'd missed out on a ton of upside, but you also already captured a 4x move before you've missed out on the double after the 4x. So just make sure that you have reasonable expectations and you are prepared to deal with losses to the upside or the downside. Thanks, you too, Brandon. All right, so I don't think there's anything to do here. This has actually cost more than I sold it for, so I'm getting, uh, I'm glad to see that I'm getting wrecked on these. I hope that we go to 430 and beyond. If we do, all of these long calls will print, which would be nice since they're down 50% over the last 35 days. Yeah, nothing else to really do. Here, this is my spending account. Let's see, what's Tesla doing? Tesla's coming back down to earth a little bit. I got my put credit spreads are still just hanging around. Gonna have to wait quite a while, I think, to capture the premium on those. I did add another Poorman's covered call in this account. And I was very aggressive with the strike. 350 is pretty high to be trying to put a Poorman's covered call against. But since this is my kind of degen money, I didn't really mind. Really going to need for the price to move to recover these losses on this leaps. Might be a little bit close to break even, collecting, premiums along the way. And this is this is kind of how it works. Like if I don't have anything expiring, I wouldn't even necessarily have to look at this account. So it's kind of easy mode. All right, so I sold this Riot put for 32. It's worth basically nothing, so I will buy it back for $1. What else I got expiring today? I sold a Riot 10.5 call. So this one might actually get called away. I mean, I could roll it out, but I think I'll just let the shares get called away in pure wheel fashion. Optimal tax situation. I can't give financial advice. I can't give tax advice either. But if you can hold on to 100 shares and not let them get called away for a year, I believe selling them after a year would give you the long-term cap gains taxes instead of short. But I'm not too worried about that. All right, so the $950 of collateral for that Riot cash secured put has been released. So now I can try to find something else. I might just go right back to the well and sell the Riot one. This kind of goes back to Dion's first question about how to choose what stocks. So I've got $1,000. I'm either going to sell a cash secured put in CLSK or Riot. Both of those have been proven to be extremely liquid. I can get into and out of trades very easily. There's a lot of God, what am I trying to say? There's a lot of open activity, or excuse me, open interest and volume in both of these. So what I like to do is just go, I'm pretty aggressive with the mining stocks. I don't care about the fundamentals. I don't know if CLSK has more hash power than Riot. I don't know really the difference. I know I don't own Mara anymore because they kind of like to shitcoin. They're not a fan of how they run their company. They were mining like Caspa for a while. They're just bad actors in the space. They're the ones that are taking money for spam, to include spam in the blockchain. So I I guess I'm taking a principled stance against Mara more than an investing stance against them. I don't have the slightest idea of if Mara is, you know, killing the game at mining. I couldn't give a fuck less. If you're going to mine Caspa, you're dead to me. So, but this is the way that I look at these. And this is just pure how much premium can I collect per collateral that I have to put up. So for a CLSK put for next week, I got to shell out $1,050 and collect 20. With Riot, and this is cool. The stocks are cooperating with me. They're almost identical in price, 1070 and 1086. So in either case, I have to put up $1,050 of collateral in case I'm forced to buy the shares at 1050. And in Riot's case, I can get paid $28. And in CLSK's case, I can only get paid 21. Now, that's the only criteria I'm really going to look at. But it makes sense also because 1073 is closer to 1050, meaning there's a higher risk that I actually would be assigned the shares because Riot only has to fall 23 cents for me to get assigned, whereas CLSK has to fall 36 cents for me to be assigned. So that's a difference in, one difference why one is paying more than the other. And that can change from week to week based on the prices of the stocks themselves. If it was CLSK was trading at 1051, then you'd probably be able to collect 35 cents or something for this. You could actually make the other argument that I should be selling against CLSK because I would be getting a bigger discount. If the price drops 36 cents, I'm getting a bigger discount off of the current price. So you have to be thinking about these two things in tandem, the guaranteed premium and the potential discount if the price falls. But for the heck of it, I'm just going to be kind of a premium whore here, and I'm going to sell this one to get the most premium. We'll see if this fills at the mid price or whether they make me replace it and sell it for 27. And that's what they're going to make me do. Oh, see, the price wobbled again. This should fill. Insta fill. Thank you. Got stuff to do. All right, so I'm using margin in Robinhood, but I have it enabled, but I'm not using any. So this is kind of like a fake number. This is not my true buying power. It's really 29.70 minus 26.50, so that's 320 bucks. So there's really nothing else I can buy here unless I could buy like some 1080s or something, but it's my cost basis on these. Okay, so I'm actually up a little bit on these, like basically break even, but up a teeny tiny smidge. So I think that's it. Hopefully this GameStop thing will get called away. I got assigned at like 29.50. My cost basis is 28 because I sold the sold the puts for $1.50, I think. So I'm selling the 28s. I would be more than happy for this to just get called away and I could be done with GameStop. It was kind of just a fun little play to do instead of just all mining stocks on this account. Since this account can't afford 100 shares of strategy, I'm showcasing, how to run the wheel on and Poorman's covered calls over here with a, smaller account. Yep, looking good today. All right, so I'm just going to let this Riot 10.5 call expire. And if it does close over 1050, my shares will get called away. And I'll have, what, $1,000 to spend on Monday that I can either sell a cash secured put into Riot again. And it looks like this will get called away for just a 21-cent profit, so $21. But I will have kept all of the premium that I collected as well. So I collected 28 when I sold the put. Actually, that's probably included in the cost basis. But I sold the call last week for 22. So I'll keep the 22 plus the difference between the cost basis and the current price. So the 22 and the 21. So maybe like $40 on $1,000 of collateral in 2 weeks, which is, let's see, 1% of 1,000 would be 10. So 4% in 2 weeks, that's 2% a week. It's not bad. But that's adding the premium collected to the call away value. Having something that I bought for 10.29 get called away at 10.50 if that happens. Price could close under 10.50 and I retain my shares. If that happens, I'll just sell another covered call on Monday morning at the open. So I think that's all I've got. And we're all caught up on the chats. So I'm not going to sit here and talk for no reason, though I seem to enjoy it. And kind of perfect timing. We're at 59 minutes. So appreciate everybody tuning in. Be good, y'all.